As of this very moment, Navitas Semiconductor stock, trading under the ticker symbol NVTS, is sitting right at $17.43, down roughly 1.5% in the middle of active intraday trading, having touched a low of $16.80 earlier in the session. Here is the reality check that is catching retail investors completely off guard right now. If you have been tracking this stock, you probably think the primary catalyst moving the needle is their direct association with the artificial intelligence infrastructure boom, specifically their recent showcase at the Computex 2026 event in Taipei. After all, the general consensus across the retail landscape is that any company supplying next-generation power delivery boards for data centers is essentially sitting on an unstoppable goldmine. The expectation is that demand for gallium nitride and silicon carbide components will perpetually outstrip supply, propelling the valuation into the stratosphere without interruption. But reality is painting a starkly different, much harsher picture for those paying close attention to the tape today. While the retail crowds are busy looking at the shiny artificial intelligence narrative, institutional players have been aggressively reacting to a massive and highly dilutive $500 million at-the-market equity program that the company quietly registered earlier this month. The fundamentals of the semiconductor market did not break down overnight, but the price institutions are willing to pay for future growth just took a massive haircut. And if you are holding this name, you need to understand the exact mechanics of what is happening under the hood. Before we examine the heavy institutional outflows, let us establish what everyone seems to believe about this sector right now. The prevailing narrative is that power semiconductors are the absolute bottleneck for the computing expansion. People assume that because companies need to drastically cut energy loss in their servers, providers of these specialized chips have unlimited pricing power. This is why we saw the stock explode upward by over 19% back on June 3rd when the company showcased its 800-volt to 6-volt direct current power delivery board at a major ecosystem event. The market saw that event, recognized the immediate association with massive computing infrastructure scaling, and sent the bid flying. However, this is where the contrarian reality sets in. The market is a discounting mechanism, and right now it is heavily discounting the fact that this company is trading at an astronomical multiple compared to its industry peers. When a firm trades at roughly 97 times forward sales, while the industry average hovers around 10 times, any sign of share dilution or macroeconomic softening triggers an immediate and violent re-rating. That is exactly what we witnessed just a couple of days ago, when the stock collapsed over 14% in a single session, bleeding lower all day long in heavy NASDAQ action. The expectation was that the sector hype would shield the stock from gravity, but the reality is that a massive shelf registration allows the company to sell new Class A shares into the market over time, creating a persistent dilution overhang that smart capital is refusing to bid up against. This dynamic creates a fascinating psychological environment for the retail trader logging into their Fidelity mobile app or setting up their Fidelity IRAs this morning. You see the dip and think it's a generational buying opportunity, completely ignoring that the broader Philadelphia Semiconductor Index has also been showing cracks as worries about capital expenditure sustainability materialize. If you are managing your capital through self-investing or seeking investment help across various investing sites, you have to look beyond surface-level press releases. When doing your online investment research, whether you use a Fidelity trading platform, rely on Fidelity Wealth Management, or hold shares in Fidelity mutual funds and Fidelity ETFs, the underlying volume profile tells the true story. Furthermore, if you manage funds through a Fidelity brokerage account, you might notice that over recent sessions, turnover has spiked significantly on the downside, with tens of millions of shares changing hands as price distribution takes hold. Intelligent Capital recognizes that while gallium nitride and silicon carbide materials are undeniably superior to legacy silicon for high-voltage power switches, the transition is capital-intensive, pushing revenue realization further out into the future. For a company valued at over $4 billion with negative operating cash flows, the market environment is becoming far less forgiving and the margin for error is shrinking rapidly. I want to pause here for a second and ask you a direct question. Comment below how many shares of Navitas Semiconductor you currently hold, or let me know if you're waiting for a deeper pullback before stepping in. Your perspective helps contextualize the retail sentiment out there right now. Now, let us examine how different market segments digest this information and allocate capital. You have a younger demographic aggressively utilizing the Robinhood app for Robinhood stock trading, often picking up Robinhood fractional shares of whatever semiconductor name is trending. They might use Robinhood cash management to sweep funds directly into high beta plays or allocate capital toward Robinhood crypto and Robinhood investments without properly considering the underlying valuation metrics. Conversely, you have more analytical traders utilizing interactive brokers and executing complex strategies through interactive brokers trading. Those using the interactive brokers platform are highly sensitive to interactive brokers fees and utilize interactive brokers account features to short into these retail-driven rallies. The interactive brokers stock trading environment is populated by participants who actually read quarterly filings and deeply understand the implications of an at-the-market equity offering. Meanwhile, individuals aiming for a middle ground approach might leverage SoFi directly or use SoFi Invest and engage in SoFi investing broadly, buying into SoFi stocks and SoFi ETFs or letting the SoFi robo-advisor manage their exposure entirely. The active investing crowd and those executing trades on the SoFi trading platform follow macroeconomic trends, and right now the trend for high multiple semiconductor names is undergoing a severe stress test. We're also seeing people turn to automated solutions like Schwab Intelligent Portfolios, hoping that an intelligent portfolio algorithm will perfectly balance their individual brokerage accounts and manage their online investing without the emotional roller coaster. But the truth is, no matter if you invest online through Fidelity or another institution, seek general investment guidance, or rely on algorithmic formulas, the sheer volatility of a stock like this requires active comprehension of the underlying business model. Speaking of the business model, let's strip away the ticker symbol and look at what Navitas actually does. Founded roughly a decade ago in Torrance, California, the firm designs ultra-efficient power semiconductors, focusing heavily on gallium nitride and silicon carbide technologies. These materials are essential for carrying power at higher voltages while minimizing energy loss. Whether looking at an electric vehicle or a massive data center, power conversion generates immense heat and wastes electricity when using traditional silicon. Transitioning to advanced materials allows these systems to run cooler, faster, and much more efficiently. They recently introduced innovations like an isolated through-hole package for their high-voltage MOSFETs, bringing incredible performance into significantly smaller footprints. While this highly technical engineering serves crucial end markets, the problem isn't the technology itself, it's the current financial structure and the massive expectations baked into the stock price. The market capitalization sits near $4 billion, yet the trailing revenue and gross margins simply don't support that figure without projecting massive, uninterrupted growth. When operating with negative margins and funding operations by selling equity, the narrative dramatically shifts from pure technological dominance to strict capital allocation. This brings us to the future outlook, where the intense tension between expectation and reality will ultimately resolve. The bullish case assumes the global build-out of artificial intelligence data centers will forcefully accelerate, forcing hardware manufacturers to adopt these advanced power delivery boards at a historic rate. If this scenario plays out as hoped, the current valuation might look cheap years from now, and the recent equity dilution will be viewed as necessary capital to fund expansion. We could see stabilization in the broader market, perhaps led by a massive resurgence in heavily weighted names like NVIDIA stock, Apple stock, or even Tesla stock, which could collectively pull the sector out of this temporary slump. In that optimistic environment, short interest gets squeezed, institutional buyers return, and retail investors utilizing their Fidelity investments, SoFi, or Robinhood would reap significant rewards. However, the bearish case is equally compelling at this moment. If macroeconomic pressures tighten or enterprise spending on server infrastructure cools down, the required revenue targets to justify a multi-billion-dollar valuation will undoubtedly be missed. In this downside scenario, the company would likely have to tap into that shelf registration even more aggressively, resulting in severe, sustained dilution for all existing shareholders. The stock would face relentless downward pressure as the harsh reality of prolonged unprofitability completely clashes with the sky-high expectations of the retail investor base. The ultimate takeaway here is that you can't simply